What if the number on your screen right now has absolutely nothing to do with the actual price of silver being exchanged between the largest institutions on this planet at this very moment? Not a hypothetical, not a thought experiment. Right now, on the 31st of March, 2026, the spot price flashing across every trading terminal in the Western world says somewhere between $67 and $73 an ounce, depending on the exact second you look at it. Fortune reports $73.30 at 8:30 a.m. Eastern. Indian market feed shows $66.90 on dollar strength, down roughly 2.45% on the session. CBS pegs at near $72.79. Free numbers, free sources, same metal, same day. And not a single one of them reflects what a buyer in Shanghai actually paid this morning to hold a 1,000-ounce bar in their hands. That number sits above $80. In January, it touched $123. The difference between the paper price and the physical price is no longer a rounding error. It is no longer a temporary arbitrage window that closes in a few hours. It is a structural fracture running through the foundation of the entire global silver pricing system. And by the time this video ends, you are going to understand exactly who benefits from that fracture, who is bleeding because of it, and why the next 166 trading days could rewrite everything the mainstream financial press has ever told you about this metal. This is OG John AG. If you're watching this channel for the first time, you have walked into the middle of what might be the most consequential period in the silver market since 1980. No sponsors here, no financial advisors paying for airtime. No bank research notes with disclaimers longer than the analysis. Just data, logic, and a community that watches closer than Wall Street wants them to. If that sounds like your kind of information, the subscribe button is right there. Join the family. Now, let us get into the numbers that nobody on financial television is showing you tonight. Start with the vaults. The COMEX warehouse system, the backbone of Western silver price discovery, is hemorrhaging metal at a pace that should be front-page news, but somehow never makes the evening broadcast. Registered silver, the only category that can actually be delivered against futures contracts, has declined 11.7% in the last 30 days alone. That is 10.1 million ounces physically withdrawn in a single month. The coverage ratio, the measure of how much deliverable metal exists relative to outstanding paper claims, has collapsed to 13.4%. That number does not mean caution. It means stress. Paper leverage now sits at 7.5 times, meaning there are 7.5 paper claims chasing every single ounce of registered metal sitting in those vaults. And that is the conservative calculation using exchange-reported figures. Zoom out further and the picture becomes almost surreal. Total COMEX inventory looks comfortable on the surface at roughly 440 million ounces across all categories, but only 124 million of those ounces are registered. Less than 30% of what is reported can actually be delivered against a contract. The rest is eligible silver metal that meets exchange purity and weight standards, but whose owners have not made it available for delivery. It is sitting in the vault. It belongs to someone. It is not for sale. And no futures contract in the world can force it onto the market. The distinction between registered and eligible is the single most misunderstood concept in precious metals. And it is the distinction that the entire COMEX pricing structure depends on you not understanding. Here is the historical context that makes these numbers truly alarming. Registered COMEX silver has declined over 80% from its 2021 peak. This is not a seasonal fluctuation. This is not a temporary repositioning between warehouse categories. This is a multi-year directional accelerating drain of deliverable metal from the system that underpins global price discovery. Previous drawdowns were smaller and shorter. In 2011, when silver last spiked toward $50, inventory dropped roughly 30% and then rebounded. The current decline is 80% and still accelerating. At the rate metal is being withdrawn, registered silver reaches zero in approximately 166 trading days. That is not a forecast. That is simple arithmetic applied to the exchange's own published withdrawal data. If COMEX cannot meet delivery demands when they arrive, the exchange faces three possible outcomes. Owners of eligible silver convert their holdings to registered, which buys time but does not solve the structural demand problem. Prices rise high enough to suppress demand and incentivize deposits, or the exchange declares force majeure and settles contracts and cash at prices that may not reflect the market value of the metal. That third outcome is the one nobody in the financial establishment wants to talk about. It is also the one that the physical market is now pricing in through premiums that dwarf anything seen in the last 40 years. So what happens when demand for delivery exceeds the registered pile? Hold that question, because the answer involves a single week in January that should have triggered alarm bells across every trading desk in the Western Hemisphere. Between early and mid-January 2026, in just 7 trading days, 33.45 million ounces of physical silver were withdrawn from COMEX vaults for delivery. That is roughly 26% of the entire registered inventory disappearing in a single week. Not rolling forward into a future contract month, not settling quietly in cash, physically removed, bars loaded, bolts emptied. JP Morgan alone issued 99% of 8.1 million ounces in a single day delivery notices, acting as the seller and the metal provider simultaneously. And here is the detail that separates noise from signal. Despite those massive deliveries clearing, open interest in the same contract increased by nearly 1,500 contracts on the same day. New buyers were arriving faster than metal was leaving the building. Someone was standing in line for silver that was already being carried out the back door. A significant portion of what is still reported as registered silver is believed to be already encumbered, pledged, allocated, subject to competing claims that the exchange reports do not itemize. The pool of truly free, unencumbered, deliverable silver is almost certainly smaller than the headline figure suggests. How much smaller? Nobody outside the vault custodians knows. And the custodians are not volunteering that information to anyone. March is COMEX's primary delivery month. The month where the system faces its highest structural stress test every single year. Open interest in the March silver contract represented approximately 500 to 528 million ounces in notional value spread across more than 100,000 contracts at 5,000 ounces each. If only 10 to 25% of those contract holders decided to stand for delivery, a conservative assumption during any period of physical stress, that translates to delivery requests between 70 and 90 million ounces against registered inventory that began the month at roughly 103 to 113 million ounces. The math leaves almost no margin, and it does not account for the fact that January, which is not even a major delivery month, already saw delivery demand running at 7 to 10 times the historical average for that period. Traders were front-running March. They were pulling metal early because they expected the squeeze to get worse, not better. For reference, December 2025 saw 46.635 million ounces delivered, representing approximately 50% of the estimated free float registered inventory cleared in a single month. These are not normal numbers. These are the numbers of a market where participants no longer trust the promise and want the metal. Now, zoom out 8,000 m. On the 1st of January, 2026, China officially implemented new export control regulations on silver, adding it to the list of dual-use strategic materials. This was not a rumor circulating on social media. This was codified policy from the Ministry of Commerce. Under the new framework, only large state-approved companies with annual production capacity of at least 80 metric tons can obtain export licenses. Hundreds of smaller and mid-sized refiners, companies that previously served as key suppliers to the global market, are now locked out. Exports below a stat-defined minimum price pegged directly to the Shanghai Exchange are effectively banned. Export volumes have been slashed by an estimated 40% compared to 2025 levels. And here is why this single policy decision matters more than almost anything else in this entire analysis. China controls between 60% and 70% of the world's refined silver supply. They are not a participant in the global silver market. They are the market. When China restricts silver exports, it is not a marginal supply adjustment. It is a structural amputation of global availability. The South China Morning Post reported that Beijing's export licensing system is expected to squeeze foreign buyers and push prices toward $100 an ounce. The global silver market was already running a deficit before China pulled the trigger. In a moment, I am going to show you a single data point that completely changes how you read everything I just said about supply. But first, let the deficit numbers sink in. For 5 consecutive years, from 2021 through 2025, total silver demand has exceeded total supply without a single year of surplus. The cumulative shortfall over that period is estimated at roughly 820 million ounces. That is nearly equivalent to an entire year of global mine production simply missing from the system. Gone, consumed, not replaced. In 2025 alone, demand reached an estimated 1.24 billion ounces while supply, including both mine production and recycling, came in at approximately 1.01 billion. A single-year deficit of over 230 million ounces. To visualize that gap, it equals the entire annual silver output of Mexico, the world's largest producer, vanishing into the space between what the world needs and what the earth produces. The Silver Institute projects a 6th consecutive deficit in 2026, estimated between 95 and 200 million ounces, depending on how industrial demand evolves. Solar panels, electric vehicles, AI semiconductor packaging, nuclear reactor control rods, 5G infrastructure, medical devices. None of these applications have a viable silver substitute at commercial scale. The demand is not speculative. It is baked into manufacturing blueprints that are already funded and under construction. Now, here is the data point I promised. The Pareto physical ratio in the global silver market stands at approximately 356 to 1. For every single ounce of physical silver that exists and can theoretically be delivered, there are 356 paper claims trading against it. 356 promises for 1 bar. The entire system functions on a single assumption, the same assumption that underpins every fractional reserve structure in finance. Nobody asks for delivery all at once. In early 2026, that assumption cracked. The Shanghai Gold Exchange became the proving ground for the new reality. Physical silver on the SG has traded at premiums of 10% to 12% over COMEX futures consistently since the export controls took effect. In late December 2025, the SG closed at $7,849 per ounce, while COMEX set near $70, a premium of more than $8 per ounce. By late January, Shanghai was printing $14, then $112, then $123 on consecutive trading days. COMEX trailed behind at $94, $12, $117. The rally was not driven by Western speculative accounts. Commitment of traders' data shows speculator positioning was actually shrinking during this period, not expanding. The usual commercial shorts, the big banks were getting squeezed and adding long exposure. This was a rally emanating from Shanghai from industrial buyers, sovereign entities, and institutional accumulators willing to pay the premium plus the VAT tax plus the freight just to hold physical bars. JP Morgan was reportedly shipping metal eastward at premiums of $10 an ounce or more above COMEX prices, with Asian recipients absorbing every additional cost without hesitation. When a buyer voluntarily pays a double-digit premium over the benchmark price, they are telling you something the benchmark itself cannot. They are telling you the benchmark is wrong. The global silver market has effectively split into 3 competing islands. Asia centered on Shanghai and the SG, where physical delivery drives pricing. North America centered on COMEX, where paper futures dominate, and Europe centered on LBMA in London, where vault levels are plummeting and lease rates signal a market operating under severe strain. Each region is now fighting for whatever metal it can control. The arbitrage mechanisms that used to compress these premiums within hours or days are breaking down because the cost of shipping, insuring, and delivering physical silver across oceans now exceeds the premium itself. The system designed to keep global silver at one unified price is splintering into regional pricing regimes. And the region with the strongest physical demand and the tightest export controls is winning the price war. Paper says crash. Physical says something completely different, and both of them cannot be right at the same time. London's LBMA vaults have lost approximately 40% of their silver holdings since 2021. The freely circulating physical silver in the London market. The metal not locked inside ETFs or allocated to specific institutional accounts is estimated to have fallen below 4,000 metric tons. Lease rates. The cost of borrowing physical silver for short trades and market making exploded from their normal range of 0.3% to 0.5% up to 33% in late 2025 and were running around 8% in January 2026, still 16 to 20 times the normal level. Market insiders described conditions where no free-floating silver was available for lending at any price. And since the LBMA discontinued publication of the gold forward offered rate benchmark in 2015, there has been no official transparent publicly available lease rate benchmark for gold or silver. These rates now exist only privately derived through dealer networks and forward pricing data accessible to a handful of institutions. The metric that signals physical stress in the system is invisible to the public. The fire alarm has been disconnected. The building is already smoking and the fire department is telling you everything is fine because they cannot see the flames from the outside. Then came Friday, the 30th of January, 2026. Silver had climbed above $117 earlier that week, touching $120 intraday on Thursday. What happened next was the most violent single-day price move in silver since 1980. The price cratered 35% in a matter of hours, plummeting from $120 to roughly $78. Gold dropped approximately 12% in the same window. Multiple independent analysts classified it as a six-signal event, a move so statistically extreme that it should occur approximately once every 1.5 million years under normal distribution assumptions. But it did not happen alone. Japanese 30-year government bond yields had a similar magnitude dislocation the same week. 36 sigma events in 7 days. The probability of that happening organically approaches zero in any honest statistical model. Here is what was happening behind the curtain while the numbers were screaming on every terminal. The CME hiked margin requirements aggressively on the same day, raising silver maintenance margins to $32,500 per contract, an increase of roughly $3,000 per contract. Across the roughly $224,867 contracts of open interest at that time, the incremental collateral demand hit approximately $675 million in a single move. That is not a correction. That is a forced leveraging event by design. Reports indicate that the London Metal Exchange went dark during the crash. HSBC's trading systems reportedly went offline and JP Morgan, according to analysis published by Felix Prin of the Goat Academy and corroborated by COMEX delivery data cited by multiple researchers, appeared to close its silver short exposure almost perfectly at the intraday low. The same day, Reuters published a story claiming the United States was stepping back from plans to guarantee a minimum price for domestic critical mineral projects. The U.S. Department of Energy subsequently called that Reuters report false and deliberately misleading. A story that moved algorithmic selling retracted after the damage was done. Time to the minute. Was it coordinated? I am not here to tell you what to believe. I am here to lay out the sequence. Margin hike systems going offline. A provably false news story hitting wires during maximum liquidation and the largest bullion bank in the world closing its short at the bottom tick. You draw your own conclusion. The collateral damage was immediate and brutal. In Rajkot, India, 44 silver trading firms declared insolvency with combined liabilities approaching $425 million. These were paper traders. They held futures positions, not physical bars. When the CME raised the margin floor, they were destroyed in hours. Their story is a permanent reminder of the difference between owning silver and owning a promise that someone else might deliver silver if they feel like it. Now, the bears deserve their full hearing. If you make decisions with real capital, you must hear the counter-thesis without filters, and I respect you enough to present it seriously. Silver has corrected more than 40% from its January peak of $120 to the current $67 to $73 range. The US-Iran war, which began on the 28th of February, has paradoxically crushed precious metals rather than boosted them. Gold logged its worst monthly decline since October 2008, falling roughly 13% in March alone. Silver dropped 30% from its March peak. The reason is counterintuitive but structurally sound. Higher oil prices from the Iran conflict with Brent crude near $110 per barrel after Iranian strikes on Middle East energy infrastructure have spiked inflation expectations. Markets have repriced the Federal Reserve's path from anticipated rate cuts to a possible rate hike. The Fed held at 350% to 3.75%, and the hawkish language sent the dollar index surging higher. A stronger dollar makes silver more expensive for every international buyer. Rising Treasury yields increase the opportunity cost of holding any non-yielding asset, and leveraged traders facing margin calls are liquidating precious metals to raise cash, creating selling pressure that has nothing to do with silver supply fundamentals. The bears argue that the parabolic move from $31 to $120 in barely 12 months was a textbook speculative blow-off and mean reversion was mathematically inevitable. J.P. Morgan Global Research published a note in early January explicitly calling for mean reversion pressure on silver. That is a legitimate analytical framework, and I would be lying to you if I dismissed it. But here is what the bearish case structurally cannot explain. The vaults are still draining. Registered conch silver is declining at 11.7% per month. At current pace, the registered pile reaches zero in 166 trading days. China's export controls are not a temporary tariff. They are structured through 2027 with no announced sunset clause. The 5-year cumulative deficit of 820 million ounces does not reverse because the paper price drops. Nobody builds fewer solar panels when silver falls from $120 to $73. No chip fabrication plant pauses production because the COMEX board shows red. The photovoltaic industry alone consumed a record volume of silver in 2025. Electric vehicle connectors, 5G antennas, and AI data center infrastructure all require silver in quantities that are increasing year over year. Industrial demand now accounts for 50 to 60% of total silver consumption globally. There is no commercial substitute for silver's conductivity in these applications at current manufacturing scale. The demand is inelastic. The Pareto physical ratio of 356 to 1 does not shrink when the price corrects. It gets worse because the same number of paper claims now chase a smaller physical base as vaults continue to empty regardless of what the futures board displays. The SLV ETF sits at $64.30 as of March 30th with a 52-week range stretching from $2,657 to $1,983. 5-day net inflows hit 370.91 million even as the price drops. But 1-month outflows total $1.94 billion and 3-month outflows reach $2.44 billion, the visible footprint of margin call liquidation. Over 1 year, net flows remain positive at $1.19 billion. The Spratt Physical Silver Trust holds 214,696,112 with a net asset value of $18.42 billion and trades at a 3.43% discount to NAV. SPAT doubled its capital raise program in January 2026 to $2 billion, enough to purchase approximately 18 million ounces, equivalent to roughly 16% of COMEX registered inventory in a single institutional move. In the past 30 days, retail investors poured a record $920 million into silver-related ETFs. SLV recorded net retail inflows for 169 consecutive trading days, a streak without precedent in the fund's entire history. Money is flowing toward physical exposure even while paper prices retreat. That divergence is the market trying to tell you something the price chart alone cannot. The gold-silver ratio today sits near 64 to 65. It was above 100 earlier in 2025 when silver was still cheap relative to gold. In January 2026, it compressed below 50 for the first time in 14 years. Goldman Sachs projects central bank gold purchases will average 70 metric tons per month in 2026, far exceeding the pre-2022 monthly average of approximately 17 tons. If gold reaches forecasted levels of $5,500 to $6,000 and the ratio compresses toward the historically observed extreme of 15 to 20, the math forces silver above $100 regardless of what the COMEX futures board displays. That ratio compression is not a theory. It has happened before. It happened in 2011. It happened in 1980. The conditions that preceded both events are present today in greater magnitude. And then there is JP Morgan, the elephant that never leaves the room, no matter how many times the press pretends it has. By late 2025, estimates place their total silver exposure at 713 to 750 million ounces through COMEX warehouse holdings and their custodian role for SLV. They accumulated the bulk of this position between 2012 and 2019 when silver languished between $14 and $20 per ounce. In September 2020, they paid a record $920.2 million to settle spoofing charges with the DOJ, CFTC, and SEC, the largest enforcement settlement in CFTC history. They admitted to wrongdoing. They entered a 3-year deferred prosecution agreement. And then the price of the metal they had spent 7 years accumulating at suppressed levels began to rise. Draw whatever conclusion that timeline suggests to you. The consensus analyst forecast for 2026 from ING, Saxo Bank, Bank of America, and HSBC clusters between $55 and $70 per ounce average. JP Morgan projects $81 average with a Q4 high of $85. Multiple independent analysts project $100 to $150 if the physical squeeze intensifies and the gold-silver ratio compresses. The spot price today near $73 already sits above the consensus average while the paper market is in full liquidation mode and the physical market is running its 6th consecutive annual deficit. That single fact should keep you up tonight. So here is where you stand. You are not watching mainstream financial coverage right now. You are not reading a bank research note designed to protect a position you will never see. You are sitting with data that most market participants either do not have access to or choose to look away from. The 356-to-1 paper ratio, the 166-day volt countdown, the Chinese silver wall, the $425 million graveyard in Rajkot, the January crash that hit every statistical impossibility marker simultaneously, while the largest bullion bank in the world closed it short at the exact bottom tick. You have all of it now. The question is not whether silver goes up or down tomorrow morning. The question is whether the system that determines that price can survive the weight of its own contradictions for another 166 trading days. If you made it to the end of this video, you are not a casual viewer. You are part of a very small, very specific group of people who track the physical reality behind the paper facade while the rest of the market watches price candles and calls it analysis. That distinction matters because when price discovery finally migrates from the leveraged dollar-denominated paper exchanges in New York and London to the physical delivery markets where actual metal changes hands, the people who understood the difference between a paper promise and a silver bar will not be caught off guard. They will already be positioned. If this breakdown puts something in front of you that your nightly news never will, hit the like button. Share it with one person who still believes the spot price tells the whole story. And subscribe if you have not already because this channel will still be here doing this work when the mainstream finally catches up to what you already know. One last thing, drop the words OG John AG 2.0 in the comments below. Not because I need engagement metrics. Because when the next person scrolls into this video and sees that phrase repeated 1,000 times, they understand instantly that this community does not skim. It reads, it watches, it verifies, and it stays until the last word. Invest with logic, never with noise. OG John AG signing.